My father was always in banking, but more on the IT side. And then when I had to make a choice, the financial crisis started. A bank failed in Belgium and it crumbled the entire economy. I was like, I want to know more. Chose economics and I never turned back. So I graduated 11 years ago. And there I felt it was more like you have to know specific things and you have to answer specific questions. Whereas nowadays it changed a bit to less application, more practical knowledge.
Thank you for coming on the podcast. It's great to have you.
Thank you very much.
I'm going to apologize to Helena in advance for the rabbit holes I'm probably going to go down.
Oh, that's all right.
My podcast.
When I looked at you up on LinkedIn, I was like, oh, you guys are going to fantastic conversation. Because you both so much more academic than I am.
I'm definitely not academic, but fascinated by markets, and some of the work you've done in portfolio construction would be really interesting to talk about, especially in the context of how people kind of save for, and invest, whether it be through managed funds or wherever it is. There's obviously an approach you can take. Now there are so many approaches that you can take and actually get really great results, and that can be DIY, funds, but I think some people work around diversification all the time to talk about today. But also, we want to hear your journey and how you came to be in New Zealand. And you've not been here long, right? You've been working at the universities for what, 4 months? 5 months?
Officially since February.
Okay.
Practically since June. So you go here and do it. Yes. So I basically quit the K Leuven in Belgium in December. Yeah. But I already planned a trip to Monash University in Melbourne for the first 6 months of this year. But I already started at the university here, but I was on leave. So it was interesting. I got so many emails like, hey, I want to have a coffee. I want to meet you. It was like, yeah, sorry, it can't. It's helping soldier. Exactly. A different country. So, but officially since June.
Right. When you have a long, illustrious career in academia, plus you've worked in industry, when did you know you wanted to be involved in, I guess, the financial industry?
Oh, straight away, actually. So my father was always in banking, more on the IT side. So I always came home with explanations, these are things that were happening. I didn't really understand, but I was always fascinated by the way how he spoke about it. His dad actually started the option market in Belgium, way back in the day. So there was always this jargon I heard, and it's like, this sounds interesting, it sounds important, but I didn't really understand what was going on. And then when I had to make a choice, the financial crisis started. And I was like, this is interesting. Just a bank failed in Belgium and it's crumbled the entire economy. I was like, I want to know more. And then I got hooked. So I chose economics and I never turned back.
That's cool. So you spent some time studying. What was so you made this decision early. You hear this jargon all the time. I'm kind of now thinking about my son and all the conversations I'm having all the time walking around my house, right? With different people, either talking about derivatives or markets or, how to be financially well. These are all different things and interests of mine. And I think people that are interested in markets and economics also are fundamentally interested in how business works. And you just having a conversation with Galina now about students and ChatGPT, and we should definitely talk about, universities and actually purpose of a university. Yeah. And kind of the purpose I assume I never went to university is to help you learn how to think.
Exactly. Yeah. That's a real transition I've seen, especially since when I was studying, which is not that long ago. So I graduated 11 years ago. And there I felt it was more like you have to know specific things and you have to answer specific questions. Whereas nowadays it's more like, hey, there's so much stuff out there. Just one of the things I give is I teach research methods. Give me a literature review. Give me what the big question is, which is important now. So you have to gather, you can search whatever you want, but make sure that you come up with knowledge, new knowledge. So that is the feeling I have. It changed a bit to less application, more practical knowledge sharing.
Do you think that's then a regression away from what was maybe perhaps better?
No, not necessarily, because like we were talking about before, like with ChatGPT, all the answers are there. So one of
They're probably wrong.
but that's the point I was going to make. So the first thing I do in my course is actually open ChatGPT and ask a question. And I say, well, this answer is wrong. So I'm going to teach you how to understand which question you have to ask to get the correct answer, because garbage in is garbage out.
Yeah.
So I still teach practical stuff, but always with applications in mind and always with critical thinking. There is an answer. You have to know it's wrong, because if you don't, you're just going to copy paste and you get an answer.
Yeah.
But like this critical thinking becomes then very important. So I don't think it's really a regression. It's just a bit changing how information flows and how to add some benefits.
Right. No, I think that GPT is a way to reduce time that you.
Yes.
Exactly. It is no substitute for thinking and understanding how something should work. Or, so if I go and ask about historical events in the past, that's a vague finger in the air response. Then I have to go, oh, okay, these are the key points that have been kind of indexed on the internet and the LLM has learned. Now let me begin and find out what's the real data, what's the real numbers, because there's numbers that matter.
Exactly. I agree. So one of the conversations we have is exactly the point you raised earlier. Is like I had to learn how to code. So MATLAB, for instance, I'd spent hours and hours and hours on it, and now the time is significantly reduced. But I still have the thinking like, okay, what does my structure look like and how should it work? And then I can add those specific things too. So in that sense, like I still liked where I was and how I studied, because it helps me indeed to reduce time, but I already know what the benchmark is and how to actually approach specific problems I have.
So is it ChatGPT with students that you're working with? Is it learning that critical thinking part, but it's also being aware of the limitations of it, and how like I don't want to talk about this. Headaches make you sound very off. Are these young people like how are they coping that change? Because they're the kind of the first generation that they really use going through this.
They are. And so I teach a lot of foreign students as well. So one approach they use is actually to improve their English. And that's one of the things they mention a lot. And that's why I moved in some course to more like questions, like if you present something and then I know whether or not you understand something. Because in that sense, to what we were saying earlier, then it helps significantly. Like the quality of the product is better, but they still are able to explain and understand what is going. So I see also a lot of positive trends for the new generation of students.
Let's it's one of those things. It's like when the internet came along and then YouTube came along, and then it's like there's so much opportunity with that media learning and that access to information. I was talking with my wife about it. I don't know if we actually talked about it on the podcast, but I was talking to Frankie and say, hey, like, we were having a conversation about basically the fact that millennials have it harder. And my argument was that we don't. And the reason we don't is because for us to learn everything that we learn now today, we'd have to go to a library if we were in our parents' time and try and order the books or get to the internet or get to the information and like download that into our brains. Whereas now we that yes, okay, education was free, but they didn't have YouTube and they didn't have the internet and they didn't have LLMs. Access to Google Sheets, which then you can write code and hook up to other APIs. That just got so much access now. And it's the game is just different, I guess.
I saw a tweet yesterday making that point. Like, there's so many free Harvard and MIT courses you can just watch on YouTube. Like, that was not possible when I was growing up. Like, not at all. And now you just open it, you do it faster 1.5 speed, and you're able to get everything for free. So I think that is an amazing advantage for sure.
Yeah.
So one of the things what I do in terms of research is I have a huge wine data set.
Yeah.
So I have 3 million observation of wine at auction prices. That is just web scraping. That is so much easier than when I had to do this, like let's say 10 years ago, because I had to manually copy everything, go to archives, because I went to some archives to get a bit of a longer data set, but if I have to do that for the 3 million observations, man, forget it. But now just one website, two websites, get everything, write code. Like there's so much more opportunities open up to do research and to learn more stuff.
So you are preparing people to go into the financial kind of industry and potentially investment banking and kind of getting them kind of the first few steps into how to think about markets, how to think about financial assets, how to think about what the value of those assets are ultimately, or what the right price is perhaps to pay. And obviously that's where the wine data set comes in, what the work you were doing there. What were the big takeaways practical on the job takeaways did you learn, or dynamics did you learn about working in investment banking?
So when I started as a market analyst. So basically what I did was every morning I went to work at 7 a.m. Asia just closed. So I had to translate what happened in Asia and I had to prepare everybody what's going to happen at 9 a.m. if European markets open. And what I did there, I wrote 2 newsletters every day together with my boss. So he was a mail writer. I helped him with everything. Just translate everything from complex material to something which is understandable for retail investors.
Okay.
So that's what I learned. Like the big thing back then was quantitative easing. Like how do you explain what that actually entails for an investor portfolio for just my dad who has an investment portfolio but doesn't care about learning all this stuff like should I buy, should I sell, what should I do? So that's what I learned, especially
At the first hard those new letters you guys were basically buy and sell recommendations.
So we didn't say ourselves what buy and sell recommendations were. So we always relied on sell side owners, which were basically behind us. But they like wrote 20-page documents, like just get that indeed in 1 paragraph, 2 paragraphs with their recommendation.
And then a link to that answer.
Exactly.
For people to dig in, which people probably wouldn't dig in.
Exactly. But if they want to, you could. But like, what is the essence? Like, why do these things matter? So that's what we did every morning. So it was stock market at breakfast, and then we had stock market at lunch, which was around 2, with more lengthy, like, okay, the market opened up. What did we see for the first couple of hours? Is it aligned with expectations and how these things matter? And also, what are we going to expect when at 3 a.m. New York opens? So that's what we did, and that's what I learned.
And how productive do you think that is for retail to consume?
I think extremely. Okay. So what we then did at 7 p.m. was we went to give presentations, and that's what our clientele basically wanted. They didn't want to go through this entire financial statement. They just wanted to know buy or sell and what. So they didn't want to spend so much time on everything. They just wanted to have it fast.
Yeah, and they were individual securities?
Individual securities, yes.
Yeah. And these were all based. And what was the persona of these people? Like, they were retail, but what did they look like? Were they 20-year-olds?
Oh, no, 60-year-old. It's more like 50-year-old white males on average. That's the population in Belgium.
Okay, and they're typically middle class to like high net worth,
Middle class.
middle class, and they might have a portfolio of some, and they might rotate it from time to time.
Exactly.
Were these guys trying to trade, or they were investors? Like, were they relying you? Because I'm thinking 3 interactions a day. That's quite a lot. So, were they traders? Were they trying to trade, or were they?
Word towards investors. So what I think when I hear the word trader is like day moves or once a week. It was more like maybe once a year.
Okay.
So there was a lot of activity when earnings
Yeah.
came out. So that's where we actually did most of our news.
Right. Around the shine.
Yeah, exactly. So that's where we basically helped them with, and where I think our main advantage was.
Right.
So I think if I recall correctly, about 10,000 people every day read the morning stuff. So it's good to know like what is going on, what can I expect. But also what we did is if you don't know, but suddenly you open your portfolio and you see like a huge red number, like why? And then they could come to our research and bit understand like why should you panic or why it's okay. But just stay.
AI isn't the kind of professional automatic, isn't it, in panic?
Let's have-
Do you think there's times where you should panic?
Wow. So I changed a lot in my philosophy from 11 years ago. So the what I learned there is people don't really ask the question why. Why are things happening? And that's why I moved in academia to better understand this question why.
And that's the progression to into basically the behavioral side.
Exactly. Yeah. So I think there are times when investors should panic because 11 years ago it was individual securities. So I've seen a lot of stocks like going from very high to extremely low and eventually go bankrupt. But if you invested in like these individual stocks, like there's money at risk and you're basically wiped out. So in that sense, like there are times if you are exposed to that, and Belgian investors are very under diversified, I should back.
So they were under diversified.
Yeah, or a very concentrated portfolio. So on average, people hold
Really?
4 to 5.
Will one of them be an ETF? Probably.
Most likely not.
Really? But yeah, that's interesting.
Yes,
Do they outperform? Well, no, they underperform.
they underperform. They underperform compared to the markets. So that's
What is the market?
like let's say about 20, for instance.
Okay, so Euro stocks. So your benchmark in Europe at the
Yeah.
So that's what your benchmarking is in the US. So when people think of the market, they actually, I feel that basically at the moment everyone feels that the market is the S&P 500.
Yeah, sure. So in Belgium, the focus was way more on home, which is about 20 or the Euro Stocks 50, maybe Stocks 600. So less so the S&P. So the focus, I feel like, especially at that time, was way more like continental Europe rather than
Yeah, but I guess things have shifted now.
it seemed that way. So I don't have the clear data, so I follow a lot of individual investors like on Facebook. It's a huge community nowadays. And the Magnificent Seven is something everybody talks about, like Google, Apple.
It's the most crowded tradable time ever in the history of the world.
Yes, yeah, it is. No, so the point I wanted to make earlier is everybody focuses on beating the benchmark. However, I feel that if you actually gained money, so you're seeing green, but you didn't beat it, everybody's still happy.
Right. Yeah, for sure.
So how have you responded to that? So you've obviously, 11 years ago, you had a view on how things are going and it's changed over time and the philosophy, like we said, conventions change. So from your personal point of view around building wealth, how have you approached it? How do you approach it now?
Very, very passively. Yeah. So if you talk about my investment strategy, I'm super boring.
Okay.
In my feeling, so when I started my academic career, you had this entire thing like efficient markets. So I'm not a huge proponent of efficient markets. Like as we talked about, I think there's a lot of behavioral biases. But what I have found is that if you actually look, like let's say Belgium or New Zealand is also a very nice example. It's not a huge market. So if you calculate, for instance, for let's say the last 30 years, the percentage of wealth creation per stock in Belgium, 50% is created by two stocks. 50% of total wealth creation. So that's where my boring advice comes in. If you diversify, the chance of having those two stocks just increases significantly. You can still outperform if you do an active selection, but if you don't have those two stocks, you only have 50% of the rest of the wealth creation. So that's where my view came in. Like when I saw these academic studies saying there's a lot of what is called skewness, a very positive return very away from what is called the average. That's where I come in. Like that's why you do diversification. You reduce potential risk, but also you increase the likelihood that there have been these huge outliers.
Okay. So, like, through your studies and your experiences, have you seen that the global climate crisis and, COVID and the impacts, the worldwide impacts, has that changed the way the general population approaches investing, that kind of thing? Would you say? Like, have you seen a change over time?
Not at all. So that well, so I also do economic history because I like it, and yeah, I mentioned my grandfather. He was a history buff. So one of the papers I wrote was about the first ever equity investment trust. So the first basic equity ETF, which was Belgian, 19th century. And if you actually go to notaries and see what people were actually holding, again, we come to this under diversification. On average, people are holding 4 or 5 stocks. Same as nowadays. So nothing really changes over the last 160 years in how many individual holdings people have. Even though there was this very cheap product, people didn't really buy it. I feel the same bit in Belgium, at least nowadays, that sure, passive management increases, but people love these active components still quite a lot. No, so I was just gonna say, like, I feel like in there are some trends, well, some relative changes over time, but like the fundamental thing still hold.
It's in these areas, like in the last 5 years or so, it's been this move in around financial literacy. And I'm not sure the same thing's been happening in Belgium. But like from my uneducated, I suppose, point of view, a lot more people you can sit down and have bare bones conversation around finance and that kind of thing. You would hope then that from that kind of mass education that, we're making smarter investment choices. But from what you've just said, how do we not?
So there is indeed the same move, especially since the global financial crisis. I've seen like financial literacy going up significantly. However, like we were talking before, I do a lot of behavioral finance, and one thing, and I can say that because I'm a man, men are overconfident if in their own ability to predict markets. Sometimes rightfully so, most of the time not really. So yes, the level of knowledge increased significantly, but the level of skill is seen as very high and luck as just pushed down as non-existent, whereas it should be most of the time a bit the opposite. So in that sense, like yes, financial literacy increased. Belgium and in New Zealand, I've seen the same thing, but doesn't really mean that we make better decisions. These decisions are just maybe more, let's say, informed, but not always rightfully so. In what sense?
It's one of those things where, you know, you can do very little and you can be doing very little and be feeling great because your portfolio is going up, and you can be doing a lot and putting in a lot of effort and be getting worse results. It's one of those industrial pursuits where your effort isn't really relevant, almost. Or right, yeah, it's all about reward.
Well, there's this very interesting paper, and it's called "Boys Will Be Boys," making that exact same point. That like just on average, the more you trade, actually, the lower your performance is. And men, unfortunately, on average, trade more than women due to this overconfidence. So we've done a study last month doing the same thing, financial literacy, but also AI literacy. We find the same thing, like men are way more confident in their own predictive ability than women. So we basically asked at the end of August, what do you believe the S&P 500 is going to do next year? So what is the percentage return you will see? And also, how confident are you in that assessment? Like men, on average, 5.5 out of 7 in their confidence in their own ability.
Good honestly.
Yeah. Women, 3.5, 3.7.
It's actually 50.
Yeah.
Do you think women by nature are just generally more tentative around that kind of thing, or because it's
like investing for women as a whole is fairly new. Like if we open stock markets and that kind of thing, you didn't really have access to it for a really long time. So do you think because we're newish to the game, we will teach it because of that, or it's inherent?
I think it's both. I think it's indeed what you're saying, but I think it's like men on average are just more confident, more alpha, and like if you think about alpha, it nicely represents what alpha generating is in financial markets. Like we want to outperform, we want to be the best. I feel on average like men are a bit more in that perspective. So to me, that translates very nicely to what you see in financial markets and across genders.
So, like for you, you moved from Belgium to New Zealand, and I know part of the reason moved to New Zealand was because of your research and that kind of thing. So, kind of aside from that, what are you doing in New Zealand to build all up?
Ooh, that's very good. That's a very good question. Hmm. Differently compared to Belgium, nothing at all, basically. So my portfolio is twofold. On the one hand, as I mentioned, like I'm very boring passive investor. On the other hand, I have wine in my portfolio because that's where my research also comes in. But I don't own real estate here or at home. So in that sense, my personal portfolio looks exactly the same. Almost.
And so, are you planning on it staying that way? Like, if you're here, so let's say you're here for the next 18 months, 2 years, whatever that looks like, are you planning to invest some things at a museum bound as others? Or not?
So unfortunately, since my visa doesn't allow me to do quite a lot, it restricts me quite a bit. However, one thing I've looked at is tiny houses.
Oh, yes.
So I've been to an expo last week, and I thought it was fascinating because like I feel rent here is way higher than in Belgium, and like having a tiny house gives you some form of like what you're seeing, hold and stability. Hold, but you don't need like the huge loan.
Or necessarily the land. Like, you can
Exactly.
own more than you rent the land.
Exactly.
Your land.
Yeah.
It's exciting.
Yes. So that's something will be easy.
Okay, cool.
Yeah.
So, that's you and your partner, yeah. And so, how had brought her along on this wealth journey, I suppose? Like, does she think about,
Why?
pardon?
Just think about why. She actually is way better in wine than I am. So we both follow a wine course, and she was number one in her class. So she way more knowledgeable on the drinking aspect and a bit more knowledgeable on the investment aspect. Yeah. It's a nice combination.
I think we had someone on the episode recently who was really into whiskey.
Okay, that's good.
Yeah, missing whiskey. And I struggle with wine and whiskey. It feels very similar. Do you feel like it's a similar, you think of it similarly? I mean, you'll say no, but to all the dynamics of trading it to gold or Bitcoin as well.
Oh, not a lot.
No, but what would you, is it close to art?
So the way how I talked about it, so I wrote an entire book on collectibles, and I especially wine for me is a nice intersection between a bond and art. So it has a bit of characteristics of both, because like wine has a rating, bond has a rating. It both illiquid. It is a fixed amount of very light. Exactly. So supply is fixed. You can buy and hold. You can buy and consume. So there are a lot of similarities. There are a lot of differences as well. But the same assets can be traded all across the world. Whereas like there's only one Picasso. So in that sense, like it's way more illiquid. So one of the things we show in our paper, on average, the same bottle of wine is being traded once every 6 months. Right. The same painting once every 9 years. Right. So in that sense, I feel it's a bit more in the illiquid side, and then we're more into like private equity and bonds rather than a crypto or gold in that sense. Because like there are a lot of stuff we
So
see
you feel like there's an intrinsic value to the wine?
yes,
Based on rating.
based on rating, based on quantity, based on climate change, for instance. Because if I'm telling you right now that the next production of Bordeaux is not going to look very well, if you really like that wine, you're going to buy the previous one. So there is some predictability that, from a rational point of view, makes a lot of sense.
Right.
As
So how does you cool to this you
So there are two options. You have a direct option, you have an indirect option. So the direct option is you have auctions. Here, for instance, webs, or you have Langton's, which is like the most liquid market in the world in terms of wine. You have an auction every week. At Langton's in Australia, for instance, it goes from $1 Australian to 100,000 or even more. So you don't need a huge amount to actually start off with. Where it becomes a little bit more tricky, where it's not the same as Bitcoin, for instance, is storage is hard because you need either a fridge or a very nice wine cellar. And well, wine cellar, it's very hard because when you constant temperature and no vibration, no light, so
Well, you couldn't put it in your tiny house then.
get that?
exactly. So one of the things you could do is you can store it in bonded warehouses. So it's basically no taxation, and there is insurance for you and everything like that. There's a cost associated with that. The cost is not that much, especially if you have a larger portfolio.
I actually benefit from having more wine in those case using those yes. And you just basically buy more online and then have them sent to your
Or to the bonded warehouse, or into the bonded warehouse, or you buy directly from somebody in the bonded warehouse. So basically, just an accounting transaction.
okay, what's the kind of storage cost a year and as a percentage of the assets under management?
So on average, would be 1.5%, 2%.
Okay, so quite high.
Yeah.
I mean, if we're thinking about like kind of an ETF, sorry, or
Oh no, compared to an ETF for sure. But I was just thinking, if you do more of an active mutual fund or a hedge fund, it's 220. Yeah, in that sense, it's a bit similar. Private equity, yeah, I think a bit similar. But yeah, compared to an ETF,
so you actually the ETF is having your own cellar or your own storage.
yes. Now, there is an indirect, and then we come to ETFs. So there are some firms around the world who actually offer a diversified portfolio of wine. Yes. So it's very much a US or UK thing, but you say £10,000 and you have physical wine that people buy and sell for you. So in that sense, it's basically
Like a structured product.
exactly like a fund, a managed funds. What are they referring to that? Right. So on average, wine gives you 8.5% per year. And that is including all of the costs I was referring to.
Okay, so after your storage costs.
Yeah.
That's a good question to return, but then given the circumstances, how liquid, right? Because the liquidity is something that I talk about a lot and is being kind of discussed more and more, especially as we are seeing a clear trend toward private equity style investments. Less liquid assets seem to be getting more interest from professionals allocating for people.
Yes. And that is one of the biggest pet peeves I have nowadays is the huge problem is that people use that illiquidity to their advantage.
Yes, I definitely do.
And I call that volatility laundering.
Yeah, it totally is. Why, man?
Because wine trades at most once every month. If you don't have a trade, there's no volatility, but sometimes you have a return. So if you calculate the Sharpe ratio, which is return divided by volatility, your volatility is super low, so your Sharpe ratio is through the roof.
Yeah, it looks very nice. It doesn't seem appropriate to use a Sharpe ratio or something so that.
Exactly, the people do.
Right.
And that's what I kept mad about. That this is nowadays, if I say anything on LinkedIn to anything, it's all about that. Because that to me is be deceiving investors.
Yeah.
Because it is illiquid by design.
So, I mean, the cynic in me sees this movement as a kind of, I guess, one last hurrah before there's like a huge transfer of wealth to different institutions and different asset classes.
Yes.
And I think it's, I mean, if I look at kind of like private credit right now, which I'm very interested in, because I actually think that it's there's a huge tail event there. Because look at Apollo's returns on their stock price has been massive, and what they do is they're basically selling relatively private debt and other equity instruments. It seems to be a mixture of both. The returns are phenomenal. The markups look great, or they don't happen. Or the markdowns don't happen. What would you say, like, how do you feel about the dichotomy of highly illiquid crowded indexing and then highly illiquid expensive private investments, and in this kind of world that's kind of like a dichotomy of two extremes, right? And they're the two most popular probably ways of allocating resources at the moment, in a sense.
Yeah. Also, the way how I see it is like, for me, I'm totally fine with private equity. I'm totally fine with collectible investing.
Yeah.
But you do it in closed-end fund setting. 10 years, you can't touch your money. Like, I'm not going to give you every month an update, or every day an update of your wealth. Like once every year, once every quarter, maybe. I don't like that, but once every year, we're going to give you. And like after 7 years, you have an option to opt out. After 10 years, we're done. And that's what I do like, because then you
That is an amazing hack for avoiding the behavioural finance.
exactly. Yeah. And then, but nowadays, as you're mentioning, like people want this illiquidity private asset, but in a daily trade.
Well, like what Apollo was saying is that they're actually saying you'll not be able to distinguish the difference between their private debt and publicly traded, I guess, bonds.
Yeah, which is not possible by design. Yeah, that's my.
But they're trying to make it happen.
Yeah.
Which will create lots of debt, which the unintended consequence will, of course, be that they create more volatility there.
Yes, exactly. So that's something you see, for instance, in wine nowadays. So wine is been coming down for the last couple of months, especially since 2022. But basically, there's nobody's buying. So the actual value of wine is significantly lower than what's currently being seen in the market for that specific reason. Like nobody is buying, so yeah, somebody bought, and that's the observation you see. But in the end, like it's something way lower, and that is indeed like if there's a financial crisis coming, it's going to be like in that year, because who buys these private debts? Who buys these private equities? High wealth investors. If they all want to move through the door at the same time, it's not going to happen. And if that becomes way bigger and it invests in specific companies and it can take down the entire economy without sounding too alarmist.
Yeah. So, do you see any similarities then between 2007 and now?
Not really, no. No, so in 2007, it was a bit more mathematical based and a bit more complex, like what the CDOs were doing, and really understand what these things are. In this sense, it's a bit easier because like it's tangible. It is companies like, let's say WeWork, for instance, you know what they do, you understand what they do. You don't really know like how much it's actually worth. That's where the entire complexity comes in, but like it's there. It's understandable.
You don't see the levels of debt through commercial real estate, private equity, the banking system at large. I mean, it's also that.
Yeah.
It's a different kind of, but yeah, okay.
The reason, if I can explain just 1 second why I'm saying this, because especially in the Netherlands and in Luxembourg, because Luxembourg is like tax haven for these side of things, you see this move towards making these private equity like very tradable and very accessible to just retail investors. And that's where I feel the real danger is, and that's why was a bit dark and pessimistic in that sense, is because like I'm fine with like people with net worth of more than $1 million like investing in these things. It's when you actually are going to involve retail investors that maybe don't understand or don't appreciate the risks because they're not presented in a specific way and they get dragged down. That is where
Yeah, for sure. Did you read a book called Stress Test?
No.
Oh, you should. Timothy Geithner from.
Oh yeah, I know of the book.
Oh, that's there. It's very interesting. You should totally get.
Yeah.
Oh, so it's novel. It's in Bachelor.
Now I can imagine. Also, I read so many books around the great financial crisis. Especially the last book I read was about Alan Greenspan, his entire biography. I enjoyed it and amazing. Yeah, that, but I don't know. It's on a to-do list.
Yeah, Stress Test is epic. I think what I feel it gave me was the appreciation of actually the global situation that kind of was impacting or the US were obviously reacting to. Everything started out with the outside of the US in a sense in 2007. The issues that we're dealing with on a daily basis were saving Greece or going in and talking to Bank of England because they were having issues. It kind of stemmed from outside. And I was talking to I think Marco, your colleague, and he was saying how phenomenal the US economy is.
Yes.
To be so robust and so it's vibrant. There's only one way to put it. It's seemingly vibrant. But so intertwined. How intertwined do you think the global economy is today?
Oh, immensely.
And do you think it's more or less intertwined today than what's happening?
Oh, way more. I think this is a conversation we had like a couple of days ago. Like, what is the main currency in the world? It's the dollar. Because why? Because there's no alternative. Like, what makes the US so great is because they have both like monetary union and a political union. Like, sure, the US on a political scale nowadays, we know with the presidential election, huge problems, but like it's nothing compared to what Europe is going through. Like in Europe, you have monetary union, but political, you have to find both Germany, Italy, and Spain, like having them on the same page, which is like enormous. And then you have so many other countries that also had to say. So Euro, well, nice idea, had some nice improvements in terms of economic development, but it's never going to be the global currency. Everything is going to go into the US. And like a friend of mine, colleagues like Sterman Nieuwenburg and Rustig, they have these papers showing that the debt of the US, like every year is increasing and increasing, but it's not driven on anything at all. It's not driven by how good the US economy is doing. Everybody just buys US debt. Like there's no fiscal responsibility. Like investors are not punishing the US economy whatsoever. They just keep buying. Why? Because there's no safe alternative in the world. So since the financial the income increases, like,
do you think that's why equities, Bitcoin, and gold have been doing so well as of late? Perhaps it is trying to find an alternative other than dollars. Yeah, because dollars are seen as trash, in a sense, I guess you could say, because with fiscal irresponsibility, you go and you go, well, those dollars are going to become worth less. So, I guess you'd probably rather own a bit of Apple than own a dollar, because at least in theory, Apple will make a few dollars.
No, that's true. And actually, I think indeed that's one of the reasons why Bitcoin or cryptocurrency as a whole is so interesting. Apart from the fact that you've seen enormous returns, is this system outside of the system, outside of conventional ways. I think that's one of the huge appeal. Like, we're just decentralized. We are not owned by anybody at all. There's no Feds, there's no ECB, there's no US government. Like, we're just going to do everything by ourselves. And that is what I find amazing about Bitcoin since 2007, that it's still here. And it was possible to create an entire payment system that doesn't require any intermediary whatsoever. We don't need a bank, but we can do transactions. Sure, there are flaws, like huge flaws, which I'm not a Bitcoin enthusiast for privacy and flaws reasons, but like the technology by itself, it's pretty extraordinary.
Yeah, sure. Your personality. Thanks for coming on. It's been an awesome episode. Really enjoyed it. And just so much very interesting.
Thank you for having me.
Yeah, awesome.